There we go.
All right, here we go. Welcome to another Watercooler Wednesday, April 1st. April 1st. So it's going to be a tough day to be watching X and all the social media sites, right? Everybody's going to have some kind of April Fool's joke.
Shenanigans.
Yeah, exactly.
Shenanigans.
For sure. I already saw some things this morning when I was just kind of perusing the news on X. I'm like, wait a minute. I'm like, no. That's right. What? Oh yeah, April Fool's Day. Yeah. But I should be able to see the spaceship go up
Yeah,
from the house today.
that's this evening. Yeah.
Yeah, 6:30. Should be able to see that lighting up pretty cool. Let's see.
Good morning
Um,
to all. Good morning to all.
yeah, joined as always by Dwayne Gibbs here on Water Cooler Wednesday. So good to see you.
Good.
Got an interesting topic. I think we do a lot of case studies on this show, but we also deviate into other areas. We've done some comparison things, such as investing in real estate or stock market or notes, that sort of thing. And yesterday I was over at a buddy's office, and he owns a real estate company, and I usually go over to his title company and get some documents notarized for the note business. So I was chatting with him, and he said, which I get asked a lot, but for some reason it just kind of dawned on me. Maybe that's a good topic. He's saying, "Hey, what's real estate doing to your business? To my business and the real estate note side of things." And I said, nothing really, and real estate sales, of course, because that's directly involved with real estate purchasing, is much more sensitive to those economic macros. You know what I mean? Interest rate fluctuations, because then you got buyers that are going, "Yeah, we're back up at 7%, man. I'm just going to
Yeah.
wait it out. I'm going to wait and
Yeah.
see what happens." So it got me to thinking and doing some research. So I figured I would compare a little bit here between notes and real estate, and what happens in the macro economy. So we'll forget for now the micro. There's all kinds of little things that can go on, which would be a different topic. But in the bigger picture of things, the things that you don't have control over, right? We don't have personal control over the inflation or interest rates or economic cycles or anything like that. So those are outside influences that directly affect your investments, all investments, not just real estate and real estate notes, but that's going to be our focus on this particular day. And I think it's an important one because it may make some of you think, well, maybe I do need to adjust my portfolio. Maybe I do need to add in notes. Some of you might go, "Man, maybe I add in a property, here or there. Perhaps I buy a property through a note, that sort of thing." So it is something that all investors should consider, because you don't want to just do something that works in one economy and then you lose it all as it goes into another economy. You want to make sure that you hedge those things out properly here. So did some research on this, and I think you'll find this pretty darn interesting. I wasn't surprised by the results. Overall, direct real estate ownership, you own the asset, and anytime you own an asset, there comes liability with it. There becomes liability with it, and of course, if you're owning property on a long-term basis, it's exposed to market swings. But so is short-term real estate. Anytime you have that ownership, because you've got operating costs and appreciation potential. Appreciation side being the good part of it, but enough of us have lived through the cycles where we saw properties going down in value, depreciating in value, and wiping out all these potential appreciation gains. We've seen that. But operating costs is very sensitive to rental markets, to short-term real estate investors, and of course, long-term investors as well. On the real estate note side, of course, we don't own the property. So it removes us from that responsibility and liability, also removes us from the potential appreciation of that property, because after all, once again, we don't own it. So there is a difference on that appreciation cycle. But again, Properties don't always appreciate. They do go down in value. And like I said, most of us have seen some of those cycles there. So with the real estate note business, you're simply collecting a flat monthly payment for a long period of time. No matter what's going on in the cycle of the economy, that number is not changing. Okay, so and it's not something that unless you have an adjustable rate mortgage, which is unusual in our side of the business, that payment is not going to go up. It's very steady. So that person's used to that payment, upside, downside. That's what their monthly amount is simply going to be. So it's a steadier type of long-term cash flow here. So just based upon on knowing the difference between the two, which one gets that bigger punch? Which one feels more impact, positive or negative, based on micro changes? And I think what you're going to find here is, as we go through this, is direct property ownership is going to be more heavily impacted by rate swings and economic cycles. There's really no escaping that, but I do want to break that down for you so you can see where we're coming from on this one. Notes are affected, but we have our own pricing ratios. And you've got to be careful when you research this type of thing. If you're just researching real estate notes and the economic impact, there's a whole difference on notes that are originated from banks and those sorts of things, which are a little bit more sensitive more sensitive to interest rate changes and economies versus buying notes on the secondary market, which is what we do. Much more insulation on that side of the business here. So I tried to make these charts where they could pop in, but I did something wrong there. So I know there's a lot of information on the screen, but a lot of you just listening to this on the podcast, because we do rebroadcast this on the podcast. We do the full video also on YouTube in addition to the live one here on Facebook. But I just have put together some simple charts that will show real property, which includes all things buying and holding, flipping, that sort of stuff, real estate notes, and then the conclusion of which is more heavily impacted here. So the first one is on rising and falling interest rates. So when overall interest rates go up, when they're rising, that means that for real estate owners, the borrowing costs are going to be higher, right? And we saw that when people got loans at 2% interest. I mean, people were scooping up properties and everything else because they're going, well, it's at 2%. And as soon as those started rising up to 7%, what happened to demand? It went down drastically. Property values started to cap. They started to, why? Because people weren't buying anymore. So the inventory levels started to go up again. Hard to do flips, because you're holding them on to a longer period of time in the marketplace. They're not selling. And every month that goes by, a lot of these flippers have high interest loans that they've got to pay, or they're going to lose that property. So definitely impacted there. What about rising interest rates with notes? You know, uh, I've got some comments on there. So existing low rate notes drop in market value, which in a way they do. Um, let's see. The best way to put this is this. If you've got a loan, a note, a seller finance note, let's say, and you wrote that at 2% interest, okay? And now interest rates have gone up and you want to sell that note, somebody's got to discount that note to get it from 2% to say 12%. And that's why you devalued your note. So we would still buy the note. We just buy it at a much deeper discount because we have to get our yield up higher. How do we get our yield up higher? We can't charge the borrower more money, can't change the terms of the note. So we increase our yield by discounting it. So if you wrote a note at 2%, we got to get it to 12%, huge discount. If you wrote a note at 10% interest, and now we're looking at a 12% yield, less of a discount there. Okay. But what I've seen over time is in our side of the note business, where we're buying on the secondary market, predominantly seller finance notes, investment created notes, those trade within a range of about 10 to 12%. It's been that way for a long time. So we're not heavily influenced by interest rate changes at all. Going up, Nope, no big deal because interest rates are not going to get back up to the point where they were during the Carter administration, where they're 18, 19%. That would have more of an impact for us. But if they're going up 6, 7%, something like that, it doesn't affect our business at all. So the more heavily impacted by rising interest rates by far is going to be direct property, owning the properties themselves. If interest rates are going down on the other side, well, that's good news for the real estate market because cheaper financing, so more buyers step into place. They can afford it. They get a better value on the property. Flips are start easier to do because you're turning the properties quickly. Refinancing starts to happen. So falling interest rates, yeah, absolutely is more impactful on the real estate side. With us in the note business, interest rates going down, it doesn't matter if they have little to no impact on us because we're still in just a different niche of lending. The loans that we're doing are not bank finance type of loans, which are impacting the real estate market. These are seller finance or investor created loans that the yields don't change as much. So it doesn't impact us at really at all. So I've seen very little change. I put 12 years, but Dwayne, it's probably longer than that, where we've seen performing notes trade in that same range. I mean, so it
Yeah.
doesn't have
Yep.
have any of that. So when it comes to falling interest rates, you would have to say again, direct property ownership is going to be more heavily impacted, but really in a positive way. Okay. So we're the steady, we haven't changed a good, high interest rates, low interest rates. We're pretty much right in the middle of everything, which is not a bad place to be. And that's why you see some real estate investors will make a lot of money in one economy and then lose it all in another. And that's the reality of it. So if you've talked with any long-term real estate investor, they've learned that lesson. What about inflation? Well, again, we got high inflation or lower and stable inflation. So high inflation is typically good for real estate because property values go up. But again, there's a limit to that as well, right? If they go up too much, then they're pricing buyers out of the marketplace. So you got to be a little careful on that. Rents have a tendency to go up in high inflation, right? So rents, property values often rise, but appreciation and appreciation can outpace the long-term cost, as you see there. But it runs to a point. And once they start pricing people out, because when inflation is up, interest rates are up, and then the whole thing starts to freeze up there. But fixed notes, they lose some purchasing power, so to speak. And what I mean by that is, yeah, if you're getting a fixed income and yeah, now that money is worth less on purchasing power, then sure, it's going to lose some real purchasing power. But that really affects everybody's money. That affects the money that's in your checking account. If inflation's at 5% and you're making 0% in your checking account, you're actually losing 5%. So that's really across the board, right? I mean, so that's not just real estate notes, but the reality is if you're living on the income that your notes are producing, then certainly one could make the argument, well, you're losing real purchasing power. Yeah, but everybody is on every dollar that they spend. So once again, with us, we can adjust for inflation by adjusting how much we're going to pay for something. So you would see deeper discounts in our business when you see high inflation to counter that loss of real purchasing power. So once again, you know, notes are a good solid place for that. So I did lean on this one to say, well, who's more heavily impacted? And notes probably just because of the fact that the money that you're receiving can purchase less things now. But again, you really got to look at that and go, yeah, but that's every dollar, not just notes. But if that's your income, that's what it is. Okay. Real estate, I would say, is not the most heavily impacted on the high inflation because it'll be good for a period of time and then it's going to stop, okay, and start to go the other way. Lower stable inflation, steady. on the real estate side. And you know what? Real estate notes, predictable cash flow, right? And cash flow is much more predictable than appreciation, everybody, right? It's that steady monthly cash flow. Appreciation could go up or down depending upon all of these factors there. So you'd have to give notes better angle on that. So we're in low, stable inflation rates. Notes is just a real solid, predictable place to be on the macro side. Making sense, Dwayne?
Yeah, absolutely. I've talked to several friends down in Southwest Florida where I live, and they're starving right now in the as realtors, um, just with the rising of interest rates and so much inventory, and there's so many dang agents out there. And I've always been a big proponent of what I have seen over the years, and I'm sure you would agree. There's so many real estate agents that are just one trick ponies. That's all they want to do is sell real estate. And I think you have to be creative. You have to be creative because there is you're at a point to where you have people that are wanting to sell their home because they need the money. And I get people don't want to go out and spend more money, but because of the interest rates. But what you have to look at is because people are wanting to get that cash, they're afraid of what's going on in the economy, and it's going to rise. It's going to come back. We always see that. But if you're a real estate agent and you understand the note business better, I really think it's just another tool to your tool bag. So you can help some of these people that have to sell their property to where creative financing could come in play, and it can help these people out.
Yeah. No, I agree. I have another buddy who's a real estate agent, and he's extremely successful, one of the top agents in the country. And he's still selling real estate. How's he doing it? He's working with a mortgage company that has a really good finance program that can get
Hmm.
people in at a low rate now. Eventually it'll go up, but it'll also be adjustable if the rate comes down. So he's understanding that part of, the financing is the fuel to it. He doesn't do so much on the seller finance side, but we've definitely had some conversations about that, and he's interested in that because you're right. I mean, there's not there's I would say very little to no real estate courses that talk about seller financing, which is really kind of interesting.
But the misconception of these real estate agents thinking, well, I'm going to lose my commission, and that's so not true.
Right. Yeah. It's just another way of financing. Right.
Yeah.
Yeah. Yeah. You got it. All right. Well, speaking of economy, um, strong economy, what do we have? Well, in a strong economy, real estate, good times, right? We got appreciation. We got people are making money, so they're going to be buying more. High rental demand, quick equity build up, all good times. And we saw the run up of that. You got to be careful on that too, because we saw that run up before 2008, where it just became so artificially fake, where interest rates were just so low. The lending practices were just set up to really just set people up for failure ultimately because anybody could get a loan. The economy was strong, and eventually that burnt itself out as well. But in a buildup of a strong economy, absolutely, direct real estate property is a big side of it because things are easy, appreciation is up, and there could be great money to be made there. Where the note side in great economies, you're not going to see the distress deals, right? So we're not buying at deeper discounts because the economy is good. But what are we going to get? Steady cash flow from performing notes. And if you're buying those things right, you're safe. You're making great return on investment there. But again, we don't have that appreciation in the asset, so you would have to just based upon that kind of swing that over to the direct property side, where in a strong economy, that one extra factor where they have appreciation, as long as you cash in on it, is going to make it a little better than the real estate notes. I'd argue that. On a weak economy, well, now it swings completely the other way.
Mm.
Property is hit dramatically bigger in this case on a weak economy because values drop. So all your appreciation that you may have built up is gone, or you're bought into a market. Your property price was at one value. Now it's down another 10%, which is extremely hard to recover from. You got higher vacancies in a weak economy. People start to, and we saw that, Dwayne, in 2008 and nine, where people just
Eight and
left
nine, yeah,
left their houses and just moved back in with mom and dad, and you had just families just doing what they had to do to get through it.
no question.
Trying to flip a property in a weak economy is just a way to burn through money. A lot of real estate investors, if you were a full-time real estate investor when the economy turned, you lost money. I know I did. I've talked with some really high level investors that were all in on real estate and they got caught too. And anybody who was in it just, it was really tough. You're sitting on flip properties. You got big high interest rate loans, not easy to do. You got maintenance, you got taxes, you got all those same burdens that are on there. Foreclosures go up. Um, and it's tough times for real property investors. Real estate note investors, on the other hand, good times, good times.
Yeah,
Non-performing notes go up, that floods the inventory, the prices go down, and Dwayne will tell you we'd had countless people that we were training in the business back then where the economy was weak and everybody was buying non-performing notes. Why? Because you could buy them at 20% of what the property was worth. And when you're able to buy them at such a deep discount, well, heck, there's all kinds of things that you can do. You can work with people, you can modify loans, you could do all sorts of stuff, which we did. There was also government programs to help people catch up. I mean, it was really good times in the note side of this. And that even if you own notes during that period of time, once again, it's that steady monthly cash flow that we're looking at. And you kind of if you think of it, where if you're in the ocean there, where we were down by the bottom of the sea where we were, but all the noise was up here, up in the waves and everything. But we were slow, steady. We were buying things really, really cheap. So in weak economy, there's no question. Most heavily impacted is the real property side on the downside. But the upside in the note business is really, really significant. In fact, what I really believe put real estate notes on the map, so to speak, of being its own asset class, like stocks and bonds and real estate notes. Real estate notes never was its own asset class or considered that by the mainstream
that's
media,
right.
let's say. It was always just a niche. And when we had that last crash, there was so much opportunity and so many things to do, and so many investors, both individual investors and Wall Street, jumped into that marketplace, and it just elevated the exposure of what that industry was in a positive way and made it its own asset class. And that's been a game changer for the business. So weak economies, for sure, real estate notes is a much better performer than real property is. And that's why full-time just real property investors who are in it long term, they go through all these cycles. And if you get caught in one cycle or another, it can wipe out everything that you've gained. Where the real estate notes is a slow, steady performer, good economy. Hey, we're still doing good. We're making good, steady performing notes, good returns. We're making double digits. But if things go bad, well, we're going to make more money. We just shift over to the non-performing notes. So, most heavily impact overall then, as you can see, is direct real property because again, it's hit harder by interest rates, economic cycles, and that could be that whole roller coaster ride, of supply, demand, values, and cost, and everything else that you have involved in that. Notes much more resilient, especially in downturns, high rate interest rate environments. Yeah, we feel a little bit of inflation, but again, I kind of put an asterisk by that. So does everybody else. It's just our purchasing power goes down, across the board. Is there anything wrong with doing a hybrid play, doing notes and real estate? course not. I don't think you've ever heard with all the recording that Dwayne and I have done, over all the years, not just on this program, but if you went back to live presentations we were doing 15 years ago across the country, I don't think you'd hear either one of us say, "Oh yeah, forget about real property. You have to do everything in notes."
That's right. That's never said.
Now there are people in the industry that say that. We're just not one of them because there's nothing wrong. I've done a lot of real estate, over the years, a lot of fix and flips, less on the rental side of things. So I'm not one of those note investors that says, "Oh no, no, notes is the only thing you should ever do." That's
And that's crazy, to
not
be
the
honest with you.
case.
Yeah.
It's totally fine to diversify on that and kind of extending on a point that you were making earlier. Not just real estate agents need to know about the note side, but real estate investors do,
Absolutely.
because that's what makes you a much rounder, um, rounded, I should say, real estate investor is understanding the finance side of it. And part of the finance side of it is the seller finance side of it. There's no question about it. So investing in real estate can make you a smarter note investor. Being a note investor can make you a smarter real estate investor. So, there's absolutely a hybrid play involved here where you can accumulate notes, get that nice, steady, good economy, bad economy doesn't matter, isn't hit overall. Start picking your play for some real estate yourself, and do a hybrid play. Um,
I
you
would
know,
say that the who's who in the business that we know do both sides of the business.
yeah, yeah. Yeah, it may be more heavily influenced on one side than another.
Right, right.
And if you're armed with this information and you're going, well, what economy are we in right now? Where should I put the bulk of my investment? Okay, great. So right now I think you're better off in real estate notes, just based on everything that we talked about. Now, if you foresee coming up in the future that we're going to have a stronger economy and that sort of thing, well, start keeping your eyes open for some real estate, some real estate, good real estate deals, and start thinking in terms of that. Going, hey, if I can catch this at the upturn of a good economy, then maybe I should put a little bit of money in that. So you absolutely can look at those sorts of things as a play, for that. So with this environment, especially right now, where the rates are, where the inflation is, and everything else, notes, no question, is a place you want to be. You're just going to have less volatility, for sure. So if you're a real estate investor who's been doing fix and flips and those sorts of things, you're in for some hard times right now. Or let's just say, hard times might be a little too much. It's going to be
Bump in the
challenging.
road.
It's going to be challenging because
Yeah.
your costs are going to be high to maintain. It's going to stay on the market longer. You got high interest rate loans that you got to pay. You got to pay back. You have a dwindling number of people who are ready to buy. They're probably out there. They're sitting on the sidelines, but they're not jumping in because they can't get good rates. So that's makes it tougher. Who knows with the current situation in the Middle East? If the price of oil does go up, and that's been another roller coaster. If the price of oil goes up, that means everything goes up. Everybody, that means your lumber, all of your materials that you need for your fix and flips are going to go up. That's just a direct cost. So notes, you won't have that sort of thing because we just don't see it in that environment. So overall, if you're not considering notes and you're in the real estate realm, you're really making a mistake, for sure.
Yeah. Yep.
Excellent. So, let me get that going on my screen back. There we go. Perfect. So, a lot to think about on that side, or not so much. Just kind of take that. If you want to research all of that stuff yourself, you absolutely can do that, and I think you'll come to the same conclusion. So, it's something that we keep an eye on overall, but you know, we're also in the business full time and understand that people are not in the business full time every single day is what I mean by that. And that's why we offer the services that we do, because I can keep an eye on that sort of stuff. Dwayne can keep an eye on that sort of stuff. And we constantly put these together. Not only do I do these, but we have special member only sessions, which I actually have one tonight, where we go into some more details for members only. So always trying to stay above the curve. Where are we right now? Where's inventory? Where's it likely heading? What kind of expectations can we see around the corner? That's something that we can do because we're in this every single day looking at deals.
I talked to a lady the other day and she was asking me about non-performing, and she said someone told her that right now the thing to buy is non-performing. And I said, how much is he in the business? What are you hearing? And she's like, oh, I'm not really sure. And I said, well, non-performing notes, everybody's been saying, oh, it's a play, but we're not seeing that inventory as what I'm hearing. So many people are really trying to focus on non-performing, but I would ask questions on the person that's training you of how long they've been in the business, how many non-performing notes are they buying today, what's that look like, and uh, just be cautious.
Yeah, we had
Be
yes,
cautious.
2 days ago, I had a consulting session, one-on-one Zoom session, which I do with my students. And this guy proposed him with a deal. And I'll round the numbers, but these are accurate numbers. The guy's got a non-performing note with the balance of about 25,000. Okay. Um, the property, according to him, could sell for 65,000 as is. If you fix it up, could go as high as
80.
200,000.
Oh, 200,000. Wow.
Yeah. Okay. Because one down the street sold for that, and the one across the street sold for 65 recently, and that was in the same kind of shape as this one. So non-performing notes, 25,000. The guy wants 45,000 for the non-performing note. So of course I'm talking with my student. I said, okay, well, think about this. You buy the note for $45,000 and the person comes up with the money to pay off the loan. How much did they pay off? 25. Yeah. How much you pay for it? 45. Congratulations. You just lost 20,000 bucks. So no, you can't
And the
do that.
first response you get, what do you mean? What do you
Yeah.
mean?
So it's just crazy. And then my student replied to the guy by email to the seller, and the note
Yeah.
seller said, no, 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 no. You're looking at this completely wrong. He said, the UPB has nothing to do with this. He goes, I'm giving up a lot of money because I don't feel like fixing up the property on it, but you could do that. So you could turn around and sell this thing if you really fixed it up for $200,000. And, I'm just asking 45, which of course makes no sense. It's like, dude, if you could
Right.
fix it up and sell it for $200,000, you're going to do that. You're not going to just take $45,000, number one. So he's lying to you. And he goes, so the guy's also saying, he goes, well, secondly, there's the borrower is not capable and doesn't want to catch up on the loan at all. And I'm like, he doesn't know that. He's projecting that on them. If they have enough potential equity in that property, they will come up with the money somehow. And I said, why hasn't this guy taken the property ownership back yet? All he's done is sent them a notice that, hey, if you don't pay a demand letter, then we will have to do this. And now he wants to sell a $25,000 non-performing note for $45,000. I said, this guy's looking for a sucker.
Mm.
And because, and he's trying to sell it to you on, no, 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 you're going to get the property. And there's no guarantee of that. And I was going to go into like,
Be careful.
well, here's,
Be careful.
here's a way to respond. I said, don't even respond to that guy. Not even worth. I was going to lay out a scenario just to paint him in a
Yeah.
corner where he looks like an idiot. But I was like, not my student, but the seller to make him look like an idiot. Or it's like, dude, what are you talking about? You can't do that. I remember that story. I don't know if you remember this, Dwayne, but this is a long time ago. Speaking of non-performing notes, we had two guys that were business partners, and they were looking at this non-performing note up in New York, and they were absolutely 100% convinced that these borrowers were going to sign a deed in lieu over. And I told them, I said, okay, first of all, New York takes 5 years to foreclose. All right, uncontested. Back then it was probably 4 years. It's five now.
Yeah. 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 Yeah.
And they said, well, it was on a Zoom call, group session, and I said, well, what if they don't sign the deed in lieu? You guys are looking down a 4-year road. Oh, we know for sure they're going to sign it. Oh, I was like, oh, I don't know that you do. I said, but what if they don't? Are you prepared for that? Because you got to prepare for worst case scenario. Worst case scenario is they told you they were going to sign deed in lieu and then they changed their mind.
Mm.
And of course, what happened? They changed their mind. I'm like, shocker. What did your coach tell you? Sometimes everybody, when your coach tells you something, listen, because it's coming from
Yeah.
from experience. So I just told these guys, I'm like, I can't believe you didn't listen to me because I'm just telling you what normally is going to happen is they're losing their house. They're going to sign a deed in lieu, and then they talk to a friend or relative, and the friend or relative knows it takes 4 years to foreclose in that state, and they tell you, don't sign anything. Stay in the house for free for 4 years. Then you can sign it over. And they're like, well, that sounds like a better idea. And guess what? That's what happened. And it's like, yep, you've got to understand when not performing, you're buying a problem, man. If you haven't thought through all those solutions, you're going to get burned. You're either going to get hustled, like my first example, or somebody's trying to sell some BS on you, or number two, you're just not going to understand human nature, what's going to happen on these deals, and you didn't prepare for worst case scenario because you knew that something was going to happen. You don't know,
Yeah.
until it
Yeah.
ultimately does. So yeah, but the inventory back to full circle is not in the not performing side right now. I glance over at them every once in a while, but everything, in my opinion, is overpriced. Why? Things we talked about. The inventory level on not performing loans is low. And therefore, some of these sellers think they can get a premium. Well, they're not getting it from me or my students, I can tell you that.
Yeah. It's crazy.
Cool. Excellent. All right, my friend. Well, enjoy the rest of your day, everybody, and we'll put together another one for you next week. And as always, check us out, kevinshortell.com, kevinshortle.com. Also, keep an eye out for some social media on my Facebook, on LinkedIn. What else you putting it on? YouTube?
Everywhere.
Everywhere. Dwayne's got some marketing or some good pieces coming out for you, marketing pieces on social media. So keep an eye out for those. We might even have a special thrown in there. You never know. So keep an eye out for it, everybody. All right. Thanks, everybody. Hope you enjoyed it. Bye now.